Unlocking the upside cuts through the noise to bring you battle-tested investment wisdom. I'm Jeff Robinson, and after 25 years on Wall Street, including running a number one ranked research franchise as managing director, I've seen it all, from building and selling companies to orchestrating leveraged buyouts. I've gathered insights that I'm excited to share with you. Joining me is Hope Stott, my sharp-minded co-host.
And I'll be keeping Jeff on his toes, trust me. I'm thrilled to be part of this. Together, we're here to challenge everything you think you know about investing. Each episode peels back layers that most investors never see, revealing hidden opportunities in today's markets. We're not here for surface-level analysis. We dig deeper, looking at businesses through multiple lenses to uncover real value.
Whether you're managing a portfolio or making your first investment, we'll equip you with professional-grade analytical tools and frameworks. No jargon, no fluff, just practical insights drawn from decades of real-world experience.
Ready to spot opportunities that others miss? Welcome to Unlocking the Upside.
Forecasting in finance, it's supposed to be a crystal ball for investors, right? Well, what if I told you that most forecasts are built on a house of cards? Today, we're diving into the biggest flaw in financial forecasting that's costing billions.
Oh, that's quite the opening statement. What exactly are we talking about here?
We're talking about inconsistent narratives in forecasting models. It's like trying to tell a story where the beginning and end don't match up, and the consequences can be dire. Let me give you a real-world example that will blow your mind.
I'm all ears. What have you got?
Picture this, it's 2008, and you're reviewing a valuation for a major software company. The growth projections are astronomical. We're talking about a 40% revenue CAGR over 5 years. Sounds like a dream scenario, right?
Well, that certainly sounds impressive. But I'm guessing there's more to this story?
You bet there is. While this model was projecting massive growth in cloud services, the reinvestment model only assumed a modest 5% annual growth in capital expenditure. It's like saying you're going to build a skyscraper with a box of toothpicks.
That's quite the vivid analogy. So, what you're saying is that the growth projections didn't align with the investment plans.
Exactly, and here's the kicker. This isn't just a one-off mistake, it's a systemic problem that plagues the world of forecasting. We call it the tale of two models, where the operating model and the reinvestment model are telling completely different stories.
That sounds like it could lead to some serious miscalculations. How does this disconnect typically manifest?
Well, it's like trying to perform a duet where each musician is playing a different song. The operating model might show explosive growth, while the reinvestment model assumes minimal capital expenditure. In reality, you can't achieve significant growth without corresponding investment.
That makes sense. So, how can analysts ensure their forecasts are realistic and consistent?
Great question. One key tool we use is called Incremental Return on Invested Capital, or ROIC. It's essentially a reality check for your forecasts. If you're showing revenue growing at 15% but investment capital barely moving, you're implicitly assuming some astronomically high returns.
And I'm guessing those high returns aren't usually realistic.
You've got it. In my experience, any forecast showing sustained incremental ROIC above 30% in a competitive industry should raise some serious red flags. It's just not sustainable in the long run.
Can you walk us through a real-world example of how this plays out?
Sure thing. Early in my career, I was covering a retail chain with some incredibly ambitious expansion plans. They were projecting to double their store count in just 3 years while maintaining industry-leading margins. On paper, it looked like a recipe for massive success.
Let me guess. The reality didn't quite match up to those rosy projections?
Bingo. When we dug into the reinvestment requirements, things like new store capex, inventory build, training costs for new staff, it became clear that either the margin assumptions were far too optimistic or the growth targets were simply unrealistic.
So what happened?
Well, the company's actual returns ended up coming in well below projections, and investors learned a tough lesson about the importance of consistent narratives in forecasting. It's a prime example of how these disconnects can have real-world consequences.
That's fascinating. You mentioned earlier that this issue is particularly problematic when it comes to terminal values in valuation models. Can you elaborate on that?
Absolutely. This is where things really get dicey. I've lost count of how many times I've seen models where the visible period shows aggressive growth with minimal investment, and then suddenly in the terminal period, everything magically normalizes.
And I'm guessing that creates some significant problems down the line?
You bet it does. It leads to what I call terminal value inflation, where the terminal value becomes disproportionately large because the visible period assumptions are simply unsustainable. Here's a quick rule of thumb. If your terminal value is more than 70% of your total valuation, it's time to take a hard look at your visible period assumptions. And
that's a really helpful benchmark. But, I can't help wondering if the problem isn't just with the analysts themselves. Could there be issues with the accounting framework that exacerbate this problem?
You've touched on a crucial point there. Both US GAAP and IFRS have some quirks that can indeed make this issue worse. For instance, many investments that drive future growth, things like R&D, customer acquisition costs, employee training, are expensed rather than capitalized. This treatment can mask the true investment requirements of a business.
Oh, that's interesting. Can you give us an example of how that plays out in practice?
Sure. Let's take pharmaceutical companies. As an example, R&D is their lifeblood. It's essentially capital investment in future products. But because it's usually expensed, traditional reinvestment metrics might miss the true capital intensity of the business. Smart analysts adjust for this by capitalizing R&D and other similar investments to get a more accurate picture of returns and investment requirements.
Wow. That really shows how complex this issue can be. So, for our listeners who might be working on forecasts or valuations, what advice would you give them to avoid these pitfalls?
I'm glad you asked. I've developed a 3-step approach that I believe can really help. First, work backwards. Start with your growth assumptions and ask, what investment would this realistically require? Use industry benchmarks and historical data as sanity checks.
That makes a lot of sense. What's the second step?
The second step is to stress test your incremental returns. Are they consistent with competitive dynamics and historical patterns? Remember, competition tends to drive returns toward the cost of capital over time. If your model assumes perpetually high returns without a strong justification, it's time to revisit your assumptions.
And the final step in your approach?
The third and final step is to ensure your visible period narrative can logically transition into your terminal value assumptions. The story needs to make sense end to end. It's not just about getting the numbers right, it's about telling a consistent story about how a business creates and sustains value over time.
That's a really powerful way to think about it. It's not just a mathematical exercise. It's about crafting a narrative that holds up to scrutiny.
Exactly. When your operating and reinvestment narratives align, that's when your valuation truly becomes credible. It's like a well-written novel. All the plot threads need to come together in a satisfying way.
I love that analogy. It really drives home the importance of consistency in forecasting. As we're discussing this, I can't help but think about how this principle of consistent narratives could be valuable in many areas of life and business, not just financial forecasting.
You're absolutely right. Whether you're planning a project, setting personal goals, or even crafting a business strategy, the principle remains the same. Your plans for growth need to align with your plans for investment and development. It's all about telling a consistent story that makes sense from start to finish.
Well, that's all the time we have for today. We've taken a deep dive into the world of forecasting and the critical importance of consistent narratives. Any final thoughts?
I think the key takeaway is this. In forecasting, as in life, consistency is key. Always question your assumptions and make sure your story holds up from beginning to end. If you can do that, you'll be well on your way to creating more accurate and credible forecasts. And remember, it's not just about impressing investors, it's about creating a roadmap that can actually guide a business towards sustainable growth.
Thanks for joining us today. And remember to check out the Insight One app on your favorite app platform. That's it from me, Hope Stott.
And from me, Jeff, at theinvestmentanalyst.com. Until next time, keep questioning those assumptions and crafting those consistent narratives. See you on the next episode in a few days' time.